The health of the U.S. economy appears to have played an important role in whether the incumbent party retained the presidency in an election year. In turn, whether the incumbent party won the White House seemed to influence market volatility before and after the past elections. Dan Kleffner with Central Bank of St. Louis joins us this morning to share why investment decisions should be based on longer-term fundamentals rather than near-term political outcomes. Dan, thank you for being here this morning.
Thanks for having me, Ty.
It's going to be an interesting November coming up. So how has the presidential election cycle historically affected the economy?
Well, it is interesting. If you go back to 1933, when FDR won the White House, there's been 8 Democratic presidents and 7 Republican presidents. And during every presidency except one, there's been a positive impact on the economy in terms of, if you use the S&P 500 as a gauge for how the economy is doing. So, and unfortunately, the one was George W. Bush, and he had a lot of hurdles to jump over. You know, he came in with the dot-com bubble, and he had 9/11 and the financial crisis. So, but long-term investments have paid out very well over time.
What does the stock market look like in those years?
Well, using the S&P 500, it's gained about 11% since 1933. So that's that's compiled over all those years. So being involved and invested in the stock market has actually paid off for investors over time.
How is consumer behavior affected in these years?
Well, during election years, consumers get a little bit nervous. You know, you've got, especially this year, you've got 2 very different candidates, and sometimes consumers make decisions to pull out of the stock market and put money in cash, which we as bankers don't have a problem with. But it is proven out that when you do that and you don't remain invested, that your returns aren't as good.
Is there normally a strong reaction from the markets immediately after the election, and how long does it typically last?
You know, that seems to be really dependent upon the policies of the administration, of the new administration. You know, fiscal policies that include taxes and spending programs are really what drives that at the end of the day.
So you guys, in short, you're saying don't let your long-term investments be impacted by a now near political.
Yeah, as an example, if you compare somebody who stays fully invested during an election year and stays fully invested through a 4-year cycle versus somebody who waits until after the election is over and invests in January of the following year, the difference, if they remain invested in the S&P 500, is 12% for those who remain fully invested versus 10% for those that don't.
2% difference over 4 years.
Which adds up over time.
It does. All right, Dan, thank you for being here. We appreciate you this morning. Going to have this full interview posted on our website, fox2now.com.